everybody, and welcome to the Fred Report Technical Market Conference Call for March 3rd, 2011. We'll get right into it here today. I know everyone's a little bit busy. Beautiful weather here in Atlanta. I hear it's not so good in other places. Some people on the call, so I'm going to enjoy myself today. First of all, let's see the stock market. So far, guys, we are holding up until we break that 129.70 area. This market trend is still up. That's actually now also the trend line from the August and November lows as well, pretty much. So we've been at a very key point, and we're certainly trying to bounce this market a little bit as well. I will say there are still some signs continuing of deterioration, so we need to watch our stops. We need to plan for the worst and hope for the best. One of the big concerns I had was the bearish sentiment number for Investors Intelligence this week, which encompassed the Libya developments as well, was only 19.1%. There just is not a fear elevation going on in the markets given the type of news and stuff that we're seeing. So while I will say, obviously this Middle Eastern business is a nice wall of worry for the market decline as we continue the bull move, the fact is no one's worrying. Everyone seems to think that this is all going to work out really, really well. And we'll just have to see. I'm not so sure, actually. And my monthly indicators are suggesting that some sort of a pullback, which may have occurred if you look at the daily indicators, the stochastics did get down enough to at least try to buy this thing. But the monthly indicators are suggesting that we could get a much nicer whack than we've had. I continue to look at this and say, if we were to pull back to 1260 on the S&P, 126 on the S&P, on the SPY, that would give us enough juice on the weeklies, especially if it were to take a little time to do that, to get a move to 140 to 145 without too much trouble in the second half of the year. And that is still tentatively what I'm expecting. This is definitely not a, oh my heavens, we've got to sell everything sort of maneuver, but we do have to just be a little bit careful here. A lot of people haven't checked their stops since last November when we got that pullback and the market is considerably higher. So let's be a little careful, and we'll see how this thing goes. Looking at the bond market has done some interesting stuff. The TLT did try to rally. It's pulled back into the 90 area. If we can hold 90 on the TLT and go sideways for a while here, it's very possible that we're going to build a right shoulder for a head and shoulders bottom, which would suggest not a huge deterioration in the bond market. We'll just have to see how that works. The accumulation models are suggesting that's what's going to happen. Coincidentally, we stalled at 109 area on the LQD, but if that goes through 109, you'll see 111 to 113. And I do think that if you're buying bonds for clients, that really is the best place to be. As part of that, the dollar has really come down. It's right on support. Corporates are going to act better if the dollar has trouble. Looking at the BWX, the international bonds, they failed at 60. The euro is also starting to fail in this resistance area. So we may see some reversal in all this stuff here. And if we do, that's going to be good for the dollar and good for U.S. markets as well. We've had a number of questions on gold and oil, and what we're seeing here is some of the front months in these commodities are doing much better than the back months. And what that means is, GLD, for example, has definitely lagged. It hasn't made all-time high closes. Basically got up to resistance and looks like it's starting to fail. The accumulation models there suggest that if the GLD pulls back to 133.50 or lower into May, you're going to want to buy that index, that ETF for a move in the second half of the year, but we are holding at resistance. Guys, if you have any of these gold stocks, the call premiums are quite rich. I did some looking at some covered calls for an institutional guy the other day, and I got to tell you that some of these call writing ideas on some of these gold stocks could work pretty well. If you're playing in oil, note that the USO has a real problem with contango and backwardation, which basically means it's very heavily weighted to the front months in oil, and those months are way up, whereas the back months are down a little bit. Have a look and talk to your ETF departments for FAs on the call. You want to look at something like DBO, which uses a 12-month average of the futures price and buys its futures contracts a little bit differently than USO going forward here. If this Middle Eastern thing is going to continue, it's going to affect more than the front months. Something like DBO, which is the PowerShares oil fund, but which is not approved, for example, by Merrill Lynch, I believe, because it's really heavy into futures contracts. There's something that everyone can buy that takes into account more than the front months. You all need to find out what that is and start to add some of that instead of USO, in my opinion. With that, we're going to go and take a look at some of the stocks that we've been asked about here.